Have you ever had that nagging feeling that the entire economic system is a game you were never taught the rules to? A high-stakes casino where the house not only always wins but wrote the laws that let it build the casino in the first place. If you have, you are not being paranoid. You are paying attention. What happened in 2008 was not a financial crisis. Let us call it what it was. A meticulously planned demolition. It was the implosion of trust, the pulverization of livelihoods, and the shattering of the quaint illusion that anyone was actually minding the store. This was no accident. It was a slow-motion train wreck, engineered over decades by the sharpest minds in finance, fueled by a level of greed that would make a dragon blush, and built upon a mountain of imaginary money disguised as financial innovation. When the whole rotten structure finally came crashing down, it did not just take Wall Street with it. It took your neighbor's home, your uncle's job, your parents' retirement savings, and the future of an entire generation. But here is the punchline to this cosmic joke, the part that is so dark it is almost funny. The people who lit the fuse, the architects of this global catastrophe, did not just walk away. They walked away richer, bailed out by the very people they had just bankrupted. If you were a regular person trying to get by in 2008, you were likely completely blindsided. One minute, the news was full of breathless stories about skyrocketing home prices and how everyone was getting rich. The next, financial titans with names like Lehman Brothers and Bear Stearns were vaporizing overnight. Your pension fund was evaporating. The stock market was a sea of red. And suddenly, your government, with a sense of urgency it never seems to find for anything else, was shoveling billions of your tax dollars into the furnace, not to help you, but to save the very institutions that had set the world on fire. The story of the 2008 meltdown is often deliberately obscured by a fog of technical jargon. Subprime lending, credit default swaps, securitization. It is designed to make your eyes glaze over. But when you strip away the Ivy League vocabulary, it is one of the oldest stories in the book, just with a modern, digital twist. It is a story about the intoxicating, corrupting power of money when it is completely untethered from responsibility. Let us turn back the clock. In the early 2000s, Wall Street had a bit of a problem. The dot-com bubble had burst, leaving a crater in their portfolios. The economy was wobbling, and the investment banks were desperate for their next big score. They found it in the one thing every American is told to believe in: real estate. Owning a home was not just the American dream. It had become the American drug of choice. And Wall Street figured out a brilliant way to become the biggest dealer on the planet. Their product was called the mortgage-backed security, or MBS. The idea was, on the surface, deceptively simple. You take thousands of individual home loans, some good, some okay, some frankly terrible, and you bundle them all together like a financial fruitcake. Then you slice up that fruitcake and sell the pieces to investors all over the world. The sales pitch was pure genius. Steady income, low risk, and backed by the most reliable asset on earth, the American home. Oh, to keep this money-printing machine roaring, the banks needed a constant supply of new mortgages. When they ran out of people with good credit and stable jobs, they did not stop. Oh no, that would be leaving money on the table. Instead, they just lowered the bar. Then they dug a trench and put the bar in it. They created subprime loans for people who had no realistic way of paying them back. Adjustable rate mortgages that started low and would later explode. They had loans that did not even require you to prove you had an income. They were famously called ninja loans. No income, no job, or assets. It did not matter. The risk, they assured everyone with a confident smile, was diversified. It was spread out. It was someone else's problem. But wait, because the genius did not stop there. What if you could make money not just on the success of these loans, but on their failure? This is where a truly diabolical invention called the credit default swap, or CDS, comes in. Think of it as an insurance policy. Investors could buy a CDS to protect themselves if the mortgage bonds went bad. But it also meant that other, more cynical players could buy these same swaps to make a direct, high-leverage bet that the bonds would fail. This created a shadow banking system where there was far more money betting on the failure of the housing market than there was in the housing market itself. It was like taking out $1 million life insurance policy on your neighbor's chronically ill cat. And who was supposed to be the referee in this madhouse? The credit rating agencies, Moody's, Standard & Poor's, and Fitch. Their job was to evaluate these financial products and warn the public about risk. Instead, they became the world's most expensive rubber stamps, slapping gold-plated A-day ratings, the highest possible score, on piles of what they knew was toxic debt. Why? Because they were being paid enormous fees by the very banks whose products they were rating. It was a spectacular conflict of interest. The watchdogs were not just asleep, they were being fed gourmet steaks by the burglars. By 2007, the party was over. As those teaser interest rates on the subprime mortgages reset to much higher levels, millions of homeowners began to default. Foreclosures swept across the country like a plague. The so-called safe mortgage-backed securities were suddenly revealed to be worthless. In September 2008, Lehman Brothers, a 158-year-old pillar of Wall Street, declared bankruptcy, sending a shockwave through the entire global financial system. The Jenga tower collapsed. Panic erupted. Banks, terrified of who might be next to fall, stopped lending to each other. Credit, the lifeblood of the modern economy, froze solid. And the consequences cascaded down to Main Street, where millions lost their homes, their jobs, and their life savings. In a single year, Americans saw over $19 trillion in household wealth vanish into thin air. But here is the truly terrifying part. You might think that was the end of the story, a lesson learned. You would be profoundly wrong. They did not just rebuild the machine, they supercharged it. And you're sitting right in the middle of it. In the aftermath, central banks, led by the U.S. Federal Reserve, unleashed a radical and unprecedented policy called quantitative easing. It is a polite, academic-sounding term for creating trillions of dollars out of thin air and injecting it directly into the financial system. The goal was to restore confidence and stimulate the economy. And it worked if you already owned stocks, bonds, or real estate. The stock market began a historic bull run. Corporate profits soared. The rich became astronomically richer. For everyone else, wages stagnated. The cost of living crept up. The fundamental chasm between the soaring fortunes of the financial markets and the struggling reality of everyday life grew into a canyon. Then came 2020. The pandemic hit, and governments did the only thing they knew how to do. They turned the money printers up to 11. More money was created in 2 years than in the entire decade following the 2008 crash. For a moment, it felt like they had discovered a cheat code for the economy. Of course, they had not. In 2021, the bill came due in the form of inflation. The very thing the experts had dismissed as a temporary blip became a stubborn, corrosive force, eating away at savings and paychecks. The central banks, once hailed as saviors, were forced into a dramatic reversal, jacking up interest rates at the fastest pace in history to fight the very inflation they had helped create. And all the old cracks in the system, the ones they had merely papered over in 2008, began to reappear. So, as we stand on the edge of what looks suspiciously like another precipice, with interest rates climbing and markets trembling, the question is not if the next domino will fall, but what happens when it does. Because this time, the system is far more fragile. Corporate and government debt levels are at all-time highs, and the financial industry has invented a whole new suite of complex, opaque products, from crypto derivatives to shadowy fintech schemes to gamble with. What can you actually learn from all of this? First, complexity is a weapon used against you. The more confusing a financial product sounds, the more likely it is designed to hide risk and extract fees. Wall Street thrives in the dark. The less you understand, the more you can be sold. Second, incentives are everything. If you tell a banker that you will bail them out no matter how reckless they are, they will take insane risks. It is not that they are evil, it is that the system is perfectly designed to reward sociopathic behavior. They get the upside, and you, the taxpayer, get stuck with the downside. Every single time. Third, and this is the most important part, financial literacy is not a hobby. It is your armor. You do not need a PhD in economics, but you must understand the basic rules of the game. You need to recognize the euphoria of a bubble. You need to question the official narratives. Policy. It was a preview of coming attractions. It was a warning. And when the next shock comes, do not expect a rescue. Expect a bailout for the connected. Expect more inflation. Expect volatility. But do not expect justice. Real wealth is not just about the money in your bank account. It is knowledge. It is the resilience to see the storm clouds gathering on the horizon and the wisdom to know how to protect yourself when the hurricane makes landfall. The system will not warn you. The headlines will not save you. But history will teach you if you are willing to listen.